Hi, this is Gayatri from Department of Commerce. Now we discuss about Indian depository receipts. A depository receipt is a type of negotiable financial security that is a trade on local stock exchange but represent a security, usually in the form of an equity that is issued by a foreign public listed companies. The DR, that means the depository receipt, which is a physical certificate, allows investors to hold shares in equity of other countries. Okay, then what is IDR? An IDR is an instrument. It is a form of a depository receipt created by an Indian depository in India against the underlying equity shares of issuing companies in order to enable foreign companies to raise funds from the Indian markets. How depository receipt introduction in India, that means introduced in India. Section 605 of A of a Companies Act 1956. This is the first step. The second step is companies issue of Indian depository receipts. The third is chapters via of the SEBI regulations. The next thing is, why do we need IDR? Some reasons are here. Diversify holding across regions, risk of portfolio getting concentrated in the home market. The next, exchange rate risk are reduced. Next, acquiring shares of global companies, allow global companies to access funds at cheaper cost. So these are the reasons we need IDR. Next is, who can issue IDR? Paid up capital and fee reserves $100, average turnover 50 millions in financial year. Second thing is profit and dividend of not less than 10% for 5 years. Next, pre-issue debt equity ratio is 2:1. Issue should not exceed 15% of paid up capital plus free reserve in a particular year. Next is, would not be redeemed into an underlying equity shares before 1 year from date of issue. Next, must be listed in its home countries. Next thing is, must be prohibited by any regulatory body to issue securities. The third next need is, must have a good track record with compliance with securities market regulation. Next, must comply with any additional criteria set by a SEBI. These are the eligibility criteria for issuing IDRs. Then how it will work? How IDR will work? First thing is, draft prospects in filled with SEBI. Next, issue fee is paid. Issuing company will obtain necessary permission and exemption from the country of its incorporation and appoint an overseas custodian bank for issue. Then fourth thing is, delivery the underlying shares to overseas bank. Then fifth thing is, trade and settlement will be similar to those of Indian shares. In this way, Indian depository receipt will work. Then who can invest in IDR? Indian companies can invest in IDR, then qualified institutional buyers can invest in IDR, then NRIs and FIIs with permission of the Reserve Bank of India can invest in IDR. Some of the eligibility criteria for investing IDRs. The minimum issue size is rupees 50 crores. Next, 90% of the issue must be subscribed. Next, automatic fundability is not permitted. These are the eligibility criteria for investing in IDRs. Some of the benefits of IDRs. Indian investors get chance to invest in foreign entity. The next benefit is easier access to IDRs than shares. Then benefit of shares acquired to IDRs also. International issuers, branding, management pools reserve a portion for employee. These are all the benefits of IDR. Some of the limitations in IDR. Strengthening eligibility norms, fundability, tradability of ideas, returns on ideas, risk, taxation, voting rights, market. These are these are all limitations of IDR. Some tax procedures for ideas. Not subject SST like shares, they're not subject to dividend distribution tax. General rules regarding capital gain taxation shall apply. No benefits for long term holders of ideas are available. Direct tax code may clarify the issues. Some of the disclosures in ideas: content of prospectus, risk factors and management, perception, market price information in home country, dividend policies, history of exchange rate in home country. The next thing is foreign investment and exchange control in home country, capital structure, financial informations. These are all relates to IDR, Indian Depository Receipts. Then second type is American Depository Receipt, that is ADR. ADR is a stock that trades in stock exchanges in the United States. It is a dollar denominated form of equity ownership in a non-US companies. Each ADR represents a specific number of shares in a foreign corporation. ADRs pay dividend in US dollar. ADRs are traded traded on NYSE, NASDQA, and AMEX in the United States. ADR was introduced in the financial market in 1927. Due to complexities involved in buying shares in foreign countries, these complexities involve trading at different prices and different currency values. So, US bank simply purchase a bulk lot of shares from the foreign companies. This bulk is then bundled into a group and reissued on NYSEs and NASDAQs and AMEX. In return, the foreign company provides detailed financial information to the sponsors or depository banks. The depository banks set the ratio of ADRs per act share of the foreign companies. For example, 10 shares of a foreign company may be equal to 1 ADR. So ratio is pledged at 10:1. The ratio typically called ADR ratio could be less than or greater than 1. The ratio is set in such a way that ADR price is high enough to show subsequently values, yet low enough to make it affordable for individual investors. Most investors avoid investing in penny stock or stock trading at very low valuations. Says a company share is traded at 50 Russian rubles per share, which is equivalent to US dollar 1.5 per shares. This low price in US dollar may not reflect the company's real valuation in the United States. It may appear like a low performing stock. That is why majority of ADRs range between $10 and $100 per shares. Thus, in the home country, says Russia, the share value is considerably less. Then each ADR would be accordingly structured for including more shares. This is to make the price of each ADR attract to buyers. Let us assume that Russian Vodak Limited trades on Russian stock exchange at rupees 127 Russian rubles. This is equivalent to US dollar 4.58. Assume this is for simplicity. Now, a US bank purchased 30 million shares of Russian Vodak Limited and reissued them in the US at a ratio of 10:1. This means that each ADR you purchase is worth 10 shares on the Russian stock exchange. A quick calculation tells us that each ADR should have a issue price of US dollar 45.8 since 10 shares equivalent to ADR. Once an ADR is priced and sold, the subsequent price is determined by supply and demand factors like any ordinary shares. In that first level, this is the most basic ADR which is not normally listed on any US stock exchange. They are traded on the OTC's market in the US. It is typically used as an indicator by foreign companies to determine interest level for its stock in North America. Then level 2, this type of ADR is listed on a US stock exchange. They are subjected to strict compliance than level 1 ADRs with regulations of Security Exchange Commission, which is a security market regulated in United States. Level 3, this is the most prestigious of the three types of. The next thing is advantage of ADR. Cost effective. ADRs are an easy and cost effective way to buy shares in foreign companies. They save money by reducing administration cost and avoiding foreign taxes on each transaction. Next advantage is diversification. Investor gains the potential to capitalize on emerging economics by investing in different countries. The third advantage is more S exposure. Foreign entities favor ADRs because they get more US exposures, allowing them to tap into the wealthy North American equity shares. In ADRs, in American Depository Receipt, some of the risks are also there. First is political risk. Investor in ADR need to ask themselves if the government of home countries is stable. Second, exchange rate risk. Stability of the home country's currency needs to be assessed as well. If the Russian ruble gets devalued, the effect will be felt on the price of ADR held by an investor. This can result in a big loss even if the company is doing well. The third risk is inflationary risk. Currency of a country with high inflation becomes less and less valuable each day. This can be big blow to the company business due to reduced purchasing power and will reflect on its shares price. These are all the risk factors involved in American Depository Receipt. Thank you.